14 million barrels of oil vanish from the market. The Strait of Hormuz is functionally closed. And while Wall Street expects a 16% earnings boom, the global economy is quietly walking into an $8 trillion AI trap. Here's the raw, institutional data they aren't telling you. Look at this number, 14 million. That is the exact number of barrels of oil per day completely shut in from the global market right now. Literally gone. Because of the escalating conflict in the Middle East, the International Energy Agency is tracking, well, the most unprecedented supply shock in modern history, with inventories draining at an absolute record pace. And behind the scenes, global energy authorities are in absolute chaos. I mean, look at this. The IEA is reporting a massive contraction of 420,000 barrels a day. But OPEC? They're telling us the exact opposite, claiming an expansion of over 1.1 million barrels a day. The highest levels of global energy authorities have entirely opposite views on where global demand is actually heading in the immediate future. Then, during the peak of this geopolitical escalation, the data reveals a shocking inversion. Bitcoin actually surged 18%, while gold, the asset historically crowned as the ultimate safe haven, dropped 5% as rising U.S. bond yields completely sapped its demand. The old rules of how money moves during a crisis, they're breaking down in real time. These fragmented events aren't isolated. They're actually part of three massive concurrent shocks reshaping global capital today: the AI bubble, the Hormuz collapse, and China's deflation trap. Now, before we unpack the raw data behind these threats, a quick but important reminder. The information provided in this explainer is for educational and analytical purposes only. It does not constitute financial, investment, or tax advice. Past performance of any asset class, including digital assets and commodities, does not guarantee future results. Please consult a registered fiduciary before making portfolio decisions. Section 1, Hormuz Collapse and Oil Divergence. Okay, let's dive into this first massive systemic threat. There is profound institutional confusion happening in the energy markets right now. Just look at the spread between these agencies. OPEC is projecting global 2026 demand at 106.5 million barrels a day, assuming steady OECD growth. But the IEA and the EIA, they're projecting a significant decline in OECD demand, keeping their global estimates much lower. That divergence, over 1.5 million barrels a day in projections, means the market is flying completely blind during a massive supply crisis. So, what does this physical disruption actually mean for the price of crude? Well, according to models from the Dallas Fed, removing close to 20% of global oil supplies from the market is expected to catapult the average West Texas intermediate price of oil to $98 per barrel. That's a huge spike. And the sheer economic destruction caused by this bottleneck is terrifying. We literally have 20% of global seaborne crude halted. Sectors like petrochemicals and aviation are severely hit, with refinery throughput just plunging. The Dallas Fed model suggests this specific shock lowers global real GDP growth by an annualized 2.9 percentage points. We're watching the worst supply shock in modern history cascade through the global economy, fundamentally altering the cost of everything. Quick pause. If you want the raw data matrix we use to uncover this AI infrastructure gap and the energy crisis, hit subscribe and turn on notifications. We drop institutional-grade macro analysis every single week. Section 2. The 8 trillion AI trap. Pivoting from physical energy to digital energy, we have to ask a tough question. Is Wall Street's tech optimism building on a catastrophic fault line? On the left, we've got the bull case. Morgan Stanley's massive earnings boom expectations project a 14 to 16% earnings per share growth, theoretically driving the S&P 500 up on the back of an AI productivity supercycle. But on the right, we have the terrifying bear case reality. The devil's advocate scenario where this entire AI capex boom is just a historic misallocation of capital. So the crucial point is this. To achieve this AI supercycle, we need to build 250 gigawatts of data centers. That requires $4 trillion in initial capital expenditure. But to actually generate a return on that, the ecosystem demands an impossible $8 trillion in net new revenue. Here's the trap, folks. Current U.S. enterprise AI adoption is practically non-existent, sitting at only 10% according to the Census Bureau. If tangible use cases don't scale fast, this entire cycle collapses. Adding geopolitical strain to this tech race, we turn to the Eurasia Group's top risks for 2026. The data shows the U.S. is currently consumed by internal restructuring, a domestic political revolution causing major global volatility. Meanwhile, China is silently moving past traditional fossil fuels to dominate the global electrification and robotics electric stack. It's a massive shift in the global balance of power. Section 3. Central Bank Policy Desynchronization. So, how do the institutions that control the money supply react to all this? With absolute desynchronization. The Bank of Japan is executing a historic monetary pivot. For decades, they maintained an ultra-loose policy with negative interest rates and yield curve control. Now, driven by broadening inflationary pressures across the Japanese economy, they are hiking rates to 0.75% and are expected to push even higher. To see just how disjointed the global financial system has become, take a look at the divergence here. The U.S. Federal Reserve is cutting rates down toward a 3.0% target to deal with labor cooling and disinflation, but the Bank of Japan, as we just saw, is actively hiking to combat inflation. Meanwhile, the People's Bank of China is running moderately loose policies to try and export its way out of a deflationary trap and property weakness. Global central banks are completely out of sync right now. Section 4. Safe havens, gold versus Bitcoin. Now, what's really interesting about this slide is figuring out how capital actually survives this level of simultaneous global fragmentation. Where do you hide? Over a 60-day crisis window, gold continues to be a defensive liquidity anchor, hitting an all-time peak of $5,595 an ounce, driven by intense central bank demand. But, according to a BlackRock analysis of historical shocks, while Bitcoin might dip in the first 10 days of a crisis, it completely changes gear over a 60-day window. It delivers massive asymmetric outperformance driven by accelerating corporate treasury adoption. Which leads to this incredible institutional thought experiment, $266,000. Analysts ran a volatility compression model. If Bitcoin's price perfectly matched gold's risk-adjusted behavior, its value would compress to roughly $266,000. It's not a direct price forecast, but it brilliantly illustrates the massive discount Bitcoin trades at relative to gold, and exactly why institutions are rushing in. Section 5. The Macro Barbell Strategy. So how do you synthesize all of these risks into one actionable framework? How do you survive a world where the U.S. is ceding the electric stack to China, and geopolitical conflict has severed 20% of global oil? Well, the secret isn't in a traditional 60-40 split. You have to step away from those legacy models. Institutional money is moving toward the macro barbell strategy. You anchor your portfolio with hard, physical international infrastructure on one side. You utilize gold as your systemic liquidity absorber to handle central bank chaos, and on the other end of the barbell, you hold Bitcoin as your asymmetric, non-fiat digital safe haven. This is what it all comes down to. The institutional divergence is just too great. Relying entirely on traditional, vulnerable systems is no longer a viable option in 2026. Protect your purchasing power outside the failing fiat system. Want to know exactly which hard infrastructure assets are insulated from the next geopolitical shock? Click the explainer on your screen right now for our deep dive into the 2026 Defense and Critical Minerals Supercycle. Stay focused, and we'll see you over there.